What is the foundation of true trading success? I'm going to share with you a workshop that I filmed with my private community where I cover three elements. The first is what winning traders do and losing traders do not. Two, accept that you will lose money because losing money is the cost of doing business. And number three, how to truly master the art of trading. It's taken me 15 years to learn this stuff to get consistent success. In this workshop, you're going to get everything. Take notes because you're going to be in for a treat. So making money from the markets is simple, but not easy. And that's what we're going to cover today. So we've got this saying up here. It's actually from one of my favorite books, Trading in the Zone. So technical analysis, also known as TA, turns the market into an endless stream of opportunity to enrich oneself. But one of the challenges is there's no one holding you accountable other than yourself. Rules, systems, and everything along those lines. So we are going to start off with the high level thinking, how we need the programs in our mind to be running on an unconscious level so we can act consistently. So when the opportunities arise, we can take action and we don't get caught up in the emotions of fear and greed, because fear and greed, once they're going in the moment, it can make you do foolish things in the market. And that's one of the reasons why trading is so difficult. So now let's just dive in. There's a few key points I want to really emphasize. You want to be successful, so we need to think differently. So there's something called the trader's paradox. How do we remain disciplined, focused, and confident in the face of constant uncertainty? Because we don't know effectively what the markets are going to be doing. So what are people, humans, you, me, just in general terms, most afraid of? There's public speaking, dying, being wrong is a major fear, and losing money. When it comes to trading, those second or the last two, being wrong and losing money, is always a possibility. And individuals, human beings, find it incredibly difficult to face that head on. But what I want to get across today is where once you got the thinking correct on the outcomes and what business we're really in, all of a sudden this gets eradicated and then we can really operate on a new level. So being wrong and losing money are in most people's top 4 worst fears. So you have to come to the terms with that you will be wrong at times in the market. We think this is going to happen, but that happens. We think this is going to happen, that happens. And you will lose money on certain trades, no matter how good the setup is and how good you are. Taking a loss in trading is just the cost of doing business. It's like a casino that runs thousands and thousands of bets. Some people are going to be big winners, big losers, but overall the house always wins. And your job is to think in terms of the casino and becoming the house. So this is what makes trading difficult, the paradox. So let's just look at the science and the art of trading. And we need to master the art of trading. And it does come with time, experience, because as you know, everything in life is difficult before it's easy. So the best traders think differently from the rest. To be successful, you must think like this. A unique set of attitudes. It allows you to stay disciplined, focused, and confident. Most people get really impacted on the last 2, 3, 4, 5 trades, especially if there's 3 or 4 out of the last 5 have been losers. All of a sudden, that's taken into the next trade. Whereas if it was a machine in a casino based on statistics, that's not going to be the case. And that's what we need to move towards. That's what you need to move towards. So you have to fully accept the possible outcomes. Accept the risk that is inherent with every trade. So a lot of time, people don't use stop losses. And they know they should be using a stop loss. But not using a stop loss is another way of you saying, I know what's going to happen in the market, so why do I need a stop loss? And that's a very fast route to blowing your whole account. So you cannot avoid the risk. You can only manage risk. How do we manage risk? Well, we can have acceptable capital exposure to find out if we're right. So typically it's 2%, 1%, or 3%. Never more than 5% if you're trading. Very different if you're holding the underlying asset, if you've got different strategies. But if you want to be a long-term, consistent winning trader, then 2%, 3%. But the most important thing is that you're predefining your risk. So if you're wrong and the trade goes against you, you've already accepted that. Now, if you read Trading in the Zone, it's a really good book on psychology of trading. Even though you might be placing a stop loss, doesn't often mean you fully accepted the risk. So let's look at risk. So learning to accept the risk is a trading skill, but very few ever learn it. Most people are thinking about making money, just about maybe placing the trade, but actually accepting risk. Really, really important. So the four primary fears is why 95% of traders, especially new traders, first 6 months, first 12 months, lose money and often blow their accounts 2, 3, 4, 5 times. A few of you I've spoken to one-on-one, and sometimes I'll ask the question, how many times have you blown your entire account? And when people think about it, they'll say 3, 4, maybe sometimes 5 times blowing the whole account. And this is one of the reasons. So again, the four fears: being wrong, losing money, missing out, and leaving money on the table. So being wrong, look, if we can get it independent, where you go, being wrong, right or wrong, that's irrelevant. If we can get that to the side. Losing money, well, if we predefine our risk and we accept that risk, then all of a sudden, point 2 is going to be much easier. Missing out on leaving money on the table. What we want to be able to do, and you want to be able to do, is when the setup's in play, the edge is in play, is to act upon that edge without fear and without reservation, but with acceptable capital exposure. And that's going to be key and fundamental to long-term success. So it's hard to change your thinking because it's wired in the unconscious, but it's easy to use tools to get a new set of behaviors, right? Tools can be really, really powerful. Trade plan, you see in the dashboard. If you've used your own checkbox in the trade plan that I've given you, the last page has got a checkbox. That's a tool. If you can start using mechanical tools to keep you from making emotional mistakes, then all of a sudden the probability of you winning long term is going to be much, much higher. So the trader's mindset is going to allow you to trade without the slightest bit of fear. Now again, this is going to take time because you're all, after all, human. So the emotions will still be there. You have to manage those emotions. But sometimes it's hard to manage them because they're literally occurring unconsciously. We operate 95% unconsciously as human beings. So how do we manage that? Well, via tools and by systems and by trade plans. That's really, really important. One of my mentors in my early days, he said to me, Jagir, look, having a trade plan does not guarantee success, but the lack of one does guarantee failure. We're on a written out trade plan, and then every decision that you make should be based on logic. Entry, trade management, and exit all the time, not emotional. And at the same time, keep a framework in place that does not allow you to become reckless. Right? And one of the simple ones is just having a stop loss, 2% risk, and only take trades that have a high probability edge. So you need rules and boundaries to guide your behavior. So a few more points I want to make here, and then we're going to go into some practical stuff. So this is the high level thinking. We're going to set 2023, the foundation in play. So then once that bedrock's in play, and it's going to require repetition, because again, it just takes time. Repetition is the mother of all skill. So you need the following to be successful. So we need rules, right? Casinos have rules. They've baked it into the games. Blackjack has approximately a 5% edge. So the house has an edge. And it just goes, right, we got the rules and they abide by the rules. The dealer has a set of rules. If he's 17, he has to stick. If it's 16, they have to hit. And you're playing against the dealer, but the dealer is just following a set of rules. And that's what we're looking to do with trading. Follow a set of rules. Double time frame momentum. Pattern price and time. Is the edge in our favor? Yes. All right, how do we trade? Swing low, stop loss above a swing high, 2% risk. So keeping it really, really simple. Responsibility comes with freedom of choice. So you need to take responsibility when you're trading, right? Because no one else is going to hold you accountable. That's one of the dangers with trading, because you don't have a boss. You got this freedom with multiple assets, hundreds, if not thousands of assets with different markets that you can choose from. So you have to be really, really disciplined and take responsibility. Internal versus external controls. So getting clear with yourself and knowing what you can and cannot control. So you can control risk, 2%, using a stop loss. We cannot control the outcome if the market is going to move up or down, but we can have control over identifying the edge and only taking trades that meet our minimum criteria. So the goal is consistency. So there's really 3 levels with trading, right? And most people focus on the last one, which is a big mistake. And the last one is making big profits. The first one is actually long-term survival. Number 2 is steady equity growth, as in growing your account size in a steady manner. And then the third one is profit. But if you just focus on trading well and trading consistently, the rest will take care of itself. If you focus on chasing the money, you will get emotional. Fear and greed, fear of missing out, all of that kicks in, and then people tend to make mistakes. So the goal is consistency. But the paradox of random outcomes but consistent results. So events that have probable outcomes can produce consistent results. That's the casino model. So when we're tossing a coin, heads or tails, right? This has been studied time and time again. It's 50-50, right? 50-50. But if you did 1,000, literally took the coin and did it 1,000 times and recorded the result 1,000 times, pretty much approximately it's going to be 50-50, right? Even if the first 5 is heads, over 1,000 is going to average out statistically. That's just statistics, the way the world works, the way numbers work. So your job is to be the casino. It's just a numbers game. The market has nothing personal for you or against you. It's just identify the edge, trade the edge. Clarify your risk, accept the responsibility, and then trade. And we're going to go into some practical examples at the end of this. So blackjack, again, to the nearest number, it's 5%, but it's 4.5% edge, and it just plays out. So paradox, uncertain outcomes, predictable results with large sample size. So the larger the sample size, the more predictable the results become. But again, every trade is independent of the other. There's no such thing as a hot streak. It's just wins and losses, and that's just the name of the game. We just want our wins to be higher than our losses. Really, really important. Trading the markets is a business. And if you want to make money in the business of trading, you need to have a plan. And if you fail to plan, you should plan to fail. So you need to develop a trade plan. To help you on your journey, I've shared my personal trade plan in the link below. It covers the 4 elements of the markets: momentum, pattern, price, and time. But more than that, objective entry strategies with a checklist, which keeps it mechanical and objective and non-emotional. Take these key ingredients that I've learned over the last 15 years, adapt it so it suits you, and then take your trading to the next level. So let's just go over a few fundamentals. So you cannot create an environment of certainty where it does not exist. That's what most amateurs are trying to do. They're trying to overanalyze, they're trying to use a million different indicators, they're trying to use, I don't know, whatever else, trying to create this feeling of certainty where it doesn't exist. No matter what you do, you're not going to get certainty. The only certainty is that certainty does not exist, just like with blackjack at the casino. This is so important. I remember I had quite a few mentors. I spent tens of thousands of pounds over a decade flying all over the world. And another one of my mentors, I was asking him, I was like, how important is psychology in trading? He's like, it's everything, Jagir. And I was like, well, why don't you spend more time teaching it? It's hard, and it is hard, because how do you change the unconscious? So sometimes it's easier to create tools and systems that force you to behave in a certain way, and that will increase the results, and that's what we're looking for. So the 5 fundamental truths about trading. Anything can happen. I don't care who you are, if you're me, if you're someone else who's been trading for 50 years, best trader on the planet, anything can happen. Every part of the market is unique. Number 2, you don't need to know what is going to happen next in order to make money. Some people are trying to guarantee what's going to happen next. That just doesn't exist. Number 3, there is a random distribution between wins and losses for any given set of variables that defines an edge. So random distribution, right? We just want to get a large sample size with high probability trades. Number 4, an edge is nothing more than an indication of a higher probability of one thing happening over another. So if you have a die in your hand with numbers 1 to 6, and we say if we get numbers 1, 2, 3, 4, we win. And if you get number 5 or 6, you lose. Well, this has a higher edge. This has a 4 out of 6 or a 2 out of 3 edge over this. So this has the edge. That's it. That's all an edge is. A higher probability of one thing happening over another. It's never a guarantee. And number 5, every moment in the market is unique. Because there's going to be times the pattern looks almost identical to a former pattern, or it's a different asset or the same asset. But if you think about it, what's involved in that price action is millions of buyers and sellers and markets and different products in that market, futures contracts, CFDs. Sometimes there's ETFs, sometimes the underlying asset, different exchanges. There's so many moving parts. So every moment in the market is unique. And that's important because you don't want to over risk. Because sometimes, let's say you had 3 wins in a row and it's all been on a wave 2 ABC correction, shorting the market. The next one comes along and it looks exactly the same as the last 4. And the last 4 have been winners. Sometimes what the amateur does, it says, look, this is a guaranteed win. That's what they say in their mind or out openly. So they say, why am I risking only 2%? Because I made a 3x the last 3 trades and made 6% 4 times. That's 6, 12, 18, 24% on my whole account. Imagine if I risked 10%. I would have made a 30, 40% on each trade and that would have changed my life. And then they risk way too much, break their rules. And the worst thing that can happen is that that trade goes their way. Why? Because it's bad learnings and bad behavior. And eventually, that's not going to be the case. When they have 3 or 4 losses in a row, all of a sudden they will burn through their account. And you've probably experienced that yourself at some point, shape or form in your early part, middle part, where you get overly confident. We just want to be mechanical about this in a really business-like fashion. So systems and tools. So let's look at this. So all you need to know, the odds are in your favor before you put on the trade. Right? That's why we want to have a minimum of a double time frame momentum. The weekly and the daily pointing down, or the daily and the 4 hour pointing down, or the daily and the 1 hour pointing down, or the 4 hour and the 1 hour pointing up. Minimum criteria. We want the edge in our favor. Ideally, we want momentum, pattern, and price as a minimum. Ideally, right? And then as you get more experience, you can kind of make different judgment calls. Number 2, how much is it going to cost you to find out if the trade is going to work out? Right? There's no such thing as a free lunch. There's no free trade. You have to risk something. So we want acceptable capital exposure. So you're taking responsibility and it has to be acceptable. You have to be comfortable with losing the 2% or the 3% or the 1%. If you're right, fantastic. We manage the trade, we compound. If we're wrong, we want to adjust the stop where appropriate. And I'm going to show you an example of that later on today. So how much is it going to cost you? And predefine that risk. Number 3, you don't need to know what is going to happen next to make money on that trade. And we never know what's going to happen next. Only what's highly probable. And then anything can happen. I think people find this is difficult, right? It is difficult. Not only people find it difficult, it is difficult. How do I get consistent results? How am I supposed to risk my money when anything can happen? I want safety. I want security. I want reassurance. I go, look, when it comes to investing and trading, it's risk. And yes, you can only manage your risk. And that's really, really important. So a big part of consistent results is eliminating errors through systems and tools. So you don't want to be risking too much. You don't want to be taking on low probability trades. You don't want to be not managing your position or managing your trade because you're thinking, okay, this market is going to move. I don't want to get stopped out. You have your trade plan. So you plan your trades and you trade your plan. That's just the end of it. It's not up for discussion. If you want to be a professional, if you want to do this in a business-like fashion and survive long-term, steady equity growth and make profits, this is just the name of the game. This is what I learned, right? I don't want to reinvent the wheel. What works is what works, and what doesn't work is what doesn't work. And this is what I found to work. So consistency always wins. Become a consistent winner by objectively identifying an edge. Objectively. So we want to have a system. Is the double time frame momentum in play? Yes or no? That's the minimum thing that I have in play, right? If it's not in play, unless there's a very rare occurrence of a perfect pattern with price and time and the momentum's almost in play, with my experience, I can make a judgment call. But 9 times out of 10, is double time frame momentum is very objective. And then pattern and then price. And if you know how to do time analysis can really, really help as well. Predefine the risk of every trade. 2%, no thinking. So you want to write this in your business plan, your trade plan ahead of time. And it's not every trade is different. It's not, oh, this one 1%, this one 5%. this one 4%, this one 9%, this one 2%. No, just this is the bet. It's 2%. That's it. Every month, every quarter, you can kind of review your trade plan, but never during an open trade. Never during an open trade. Number 3, completely accept the risk. 4, act on your edges without reservation or hesitation. This can be difficult because if you've had 3 losses in a row and you're new, you might be second guessing yourself. You might be thinking, is my edge strong enough? What if this doesn't work out? And again, the fear of being wrong, the fear of losing money, the emotions. That's why we need that business plan in play and then to execute that plan. So once the edge is in play, you place the trade. But you get it? No, there is no buts. Acceptable capital exposure. If the trade's in play, place the trade. If it's an asset you're looking at, place the trade. But look, there is no but. Just place the trade. Hopefully that's making sense. Number 5, continually monitor your susceptibility for making errors. You're human after all. So if you find yourself making errors or feeling a certain way, you then need to look for a tool to mitigate that, right? And it might be unique to yourself. So just be open that there might be areas where you might be making mistakes or susceptible to making mistakes or almost making mistakes. What can you put into play? It might be as simple as an extra part of your checklist. And number 6, understand the absolute necessity of these principles of consistent success and therefore never violate them, right? You want your trade plan in play. These are all things that should be in your trade plan. Once they're in your trade plan, that's it. And the more you can do that mechanically, the better. So that was the theory part, right? Just I wanted to touch upon this a bit more because it's in some of the training that I've created for you, especially in the entry to exit course. The first section, I covered this in a lot of depth, but I just wanted to loop back because for 2023 to be a successful year for you, you need to get consistent. But there's some fundamental truths that have been trialed and tested and figured out before us in the last few decades and the last few centuries, right? We can just plug and play and learn from that. So what we're going to go into now in the next part of the workshop, I'm going to just check if there's any questions regarding what we covered so far as well, is really now looking at the practical application of double time frame momentum. One of the reasons I love double time frame momentum is it's 100% objective, right? It's mathematical. I've created the trend identifier dashboard, and if you used it, you should notice that it's very objective. The double time frame momentum is either in play or it's not. You should either consider buying or selling or stand aside. It's pretty much very, very simple. So with double time frame momentum, the high level thinking and the concept is to trade in the direction of the higher degree trend. Now, again, depending on your experience, higher degree trend means you want to look at 2 time frames. And we're talking about momentum because we're going to talk about pattern and we're going to talk about momentum cycles. Momentum is different from price. Momentum is like a rhythm. It's like a rhythm, and the market tends to move in a rhythm. And it's the momentum. Is the momentum up? Is it down? Is it up? Is it down? And more often than not, it tends to correlate nicely with price being up or down, up or down. And what we want to do, like think of it as a tide, as a wave, and as a ripple. And the waves are constantly moving. But if the tide and the wave are in the same direction, it means there's a higher probability that the thing's going to keep moving in that direction. If the wave is against the tide, then all of a sudden it's a lower probability. And we want to just look at that in a particular concept. But we want to do it in a practical way. So it's simple, it's logical, it's repeatable, and it's recordable. Right? Simple, logical, repeatable, and recordable. Very, very important. So double time frame momentum is one of the simplest but most powerful things I've ever come across. Is to choose an indicator. My favorite by far is the stochastics RSI. But you can use RSI, you can use moving averages, you can use stochastics, you can use MACD, you can use, there's thousands of them. My favorite by far was the stochastics RSI, mainly because it's a simple blue and red line that really correlates nicely if you get the settings right, and I give you the settings, with the price action. So this is what it looks like. Now, if you've used the dashboard, the trend identifier dashboard, everything I'm about to cover, I've basically programmed into the dashboard. So what I'm going to say, how you should be seeing this, it literally says it in layman's terms on the dashboard. And we're going to use the dashboard for two trade examples, two trades that we took this week. One was a win, one was a loss, but we're going to look at the mechanics of how we did that as well. So when we're looking at this, we've got the higher degree time frame. So I've just put them side by side, but normally they're on two separate charts. We've got the higher degree time frame on the left-hand side and the lower degree time frame on the right-hand side. And the higher degree time frame in this red box, at this point, it would be something called oversold because it's below that black line. And then this point over here is called a bull reversal. It's basically when the blue line goes above the red, it tells us now the momentum on the tide, on the bigger degree, is now pointing up. So what do we want to do? We want to be patient for the lower degree time frame to point in the same direction. Why? Because it increases the probability of, if we find a buying opportunity, that the trend is going to continue up, right? Doesn't mean it's guaranteed, because we never know what's going to happen. That means there's a higher probability. So we're now acting like a casino. So on the lower degree time frame, in this example, using the daily chart, and saying on the next bull reversal, basically when the blue line goes over the red, we want to look for buying opportunities, right? So on the left-hand side, weekly, the minimum criteria is that the higher degree time frame is oversold. Basically, it means it's below that black line in that area, or it's bullish. And on the right-hand side, the lower degree time frame is we want that to be bullish. The blue line has to go over the red. So a few examples of higher degree and lower degree time frames. Now, if you're new to this, don't worry. Everything in life is difficult before it's easy. But if you can get your head around this concept, and I'm going to show you how you can use the dashboard to help you. That's why we created it, because I know sometimes this can be a bit difficult if you're new. So it could be a higher degree time frame, could be a weekly, lower degree time frame could be a daily. Right? So they go together. You could have a daily and a 4 hour. And you can have a 4 hour and a 1 hour. You could also have a daily and a 1 hour. What I most commonly use is actually weekly and daily. But then I actually look to enter the trade on a pattern position on an hourly. That's my absolute favorite, because then we're using 3 time frames. A bit more advanced, but 3 time frames is a triple time frame momentum setup. But 2 is more than enough as well. But this criteria we want to use in conjunction with pattern, at least pattern, right? Just get familiar with using it with pattern. And then pattern and price. That makes it a stronger edge, a stronger probability that we're going to have a trend continuation. And then if you know how to do time analysis, if you're taking the Fibonacci time course, add time in as well. And when those coincide, momentum, pattern, price, and time, you now have a strong edge in your favor. So now let's just look at a couple of examples here. So higher time frame overbought, lower time frame bear reversal, blue line goes below the red. In conjunction with pattern, price, and time, we can look for setups. So let's just do an example with a pattern position, and then I'm going to show you a couple of live charts. Or actually what we did this week. So we've got what looks like in this theory example is, let me just draw on the chart itself. Let me just draw this here. What we've got over here is a market that's moving down. So the trend is down. We've got the weekly momentum, which is called overbought. In other words, it's above this black line. And I set this number as 75. That's called overbought. We've got the daily momentum, which has made a bear reversal. In other words, the blue line's gone below the red. And again, I'm going to show you how the dashboard simplifies this. I spent so much time thinking about the language in the dashboard. And if I was sitting on your shoulder, looking at the momentum for you, what would I be saying to you? That's how I create the dashboard. So that momentum position's in play. Then we're looking at this potential wave 4. Keeping it simple, it looks like an A, B, C correction, where the wave C is breaking down to a potential 1, 2, 3, 4, 5. So once the conditions are in play, what we want to do is have a trade strategy. We now have to make a decision. We have to make a decision on how much are we willing to risk to find out if we're right, usually 2%. And what is the trade plan? Well, the trade plan is if the price goes below this swing low, that would be the first early confirmation that this top is likely to hold. So therefore, I want my stop loss over here. Well, that's the trade strategy. And that's it. How much are we willing to risk? 2%. If the trade goes our way and we get stopped out, we lose 2%. That's just nature of business. If the trade goes in our favor, we can move our stop loss to break even, and now it's a risk-free trade, and then we can manage our trade and have a trade plan as well. So now I'm going to show you, I think I got one more part to this. So if it went in our favor, that would be all great. So double time frame momentum. We've got pattern. We would do some price ratios with this as well. And then entry would be on a follow through on a swing low. So now, last part I want to do as part of this workshop before I really open up the floor for Q&A is really look at two examples, two trades that we took this week. One was a winner, one was a loser. Both looked equally as good, and we wouldn't have known at the beginning which one was going to be a winner, which one was going to be a loser. But it's more the methodology that was applied of consistent trading in a mechanical manner that we can repeat for 1,000 trades without really having much thinking to be done. So let me just check if you guys have got any questions. No questions at the moment. Fantastic. All right, so I'm just going to bring up a chart. The first trade I'm going to talk about is actually a Forex trade. So a foreign exchange currency trade with the euro versus the US dollar. Now, the great thing about the methodology that we use is that it's relevant for all markets and all time frames. Momentum, pattern, price, and time. One of the things I love about it. If we're looking at the euro dollar, if we're looking at Bitcoin, if we're looking at gold, if we're looking at Tesla stock, if we're looking at oil, all of it is the same methodology. And if you look at the example that we just went over here with this, you'll see that the euro US dollar, very similar. We looked at this as a potential wave 4 and we anticipated a wave 5 to occur, right? And this is the live version of that. I've just taken the data back to last week before we entered the trade, so you can see this in a practical manner. The trade thesis and the trade plan doesn't mean it's going to unfold, but it looks like the market is making a wave 1, a wave 2. It looks like it's made a pretty aggressive wave 3. It looks like an A, B, C of a potential wave 4, and you'll notice I put a question mark there. The current momentum, I'm also aware at this point the weekly momentum is bearish, the daily momentum is bearish. So the daily would be really, really important because I like to look at the immediate time frame above as well. But I've just got on the chart as the higher degree trend is the 4-hour chart and the 1 hour. And what I want is I want this and this to be pointing in the same direction. And right now at this moment with this data is not pointing in the same direction. And what does the trend dashboard tell us? It says, well, Jagir, what to do is stand aside, wait. Just wait. It's not high probability right now. Why? Because the market might continue to the upside like this. So I'm not ready to enter. So what I want to do, my trade plan with this is literally wait for this to become bearish. This what to do section is going to say consider selling or consider taking a short position. If the price has not gone above this high over here, and this becomes bearish, then I want to look for a logical place to enter this trade, which will also confirm that the market is likely to continue to the downside. Right? Make sense? Hopefully that makes sense. Any of this, by the way, if questions are popping into your head, just pop them into the Q&A because we'll loop back on this at the end of this example. And then I got one more example for you. So the trade thesis is, if this is a wave 1, 2, 3, 4, and it's going to make a wave 5, well, then this low should get exceeded. And the high probability wave 5 zone is something called a wave 5 external retracement zone over here. So I go, okay, there's a good movement that's worthwhile taking for a short-term trade. So now let's just unfold some data. I'm just going to squeeze this chart in a little bit. We're going to unfold some data, but we're going to really pay special attention to the dashboard, in particular this area and this over here, right? Really, really important. So let's just unfold some data. So I'm unfolding it one bar at a time. Boom. At this point, you notice I don't even have the blue and the red lines on the chart because I wanted to simplify this, because this interprets that information, translates it and puts it into English, right? Into English. Well, that was my aim anyway. Hopefully you can read the English, what I'm trying to go for over here. So now The higher degree time frame says it's strong bear downtrend. The lower degree time frame, the smaller trend on the hourly, says bear downtrend. And what to do says consider selling. So we're now consider taking a short position. And what we simply did, this is an actual trade that we took in the Done For You service. We said, okay, if the market goes below this low, I'm just going to make it green. I always put entries in the green. I want to go short below this low, and I want to have my stop loss here. How much am I willing to risk? 2%. That's it. That's the trade plan. All right, so now let's just unfold this data to see if the trade gets triggered. Boom. Literally within a few hours, the trade got triggered, and it was a nice movement to the downside. The next question I asked myself, and I'm keeping it very logical, very mechanical, very non-emotional, is in my business plan, is in my trade plan. My question is, what should the market not do if the trend is to continue to the downside? Okay, well, if this is in fact a wave 4 and we're on the way of making a wave 5 and the market's moved down and up, it looks like some type of wave 1, wave 2, and it's gone back into this range over here now. So what should the market not do? Well, it doesn't mean it can't do, and I'll show you in the next example, is it should not overlap into this wave structure. Right? It's called a pattern reversal signal. If it does overlap back into that wave structure, something else is probably occurring, and it's likely the pattern's going to continue to the upside and stop us out. So what we did in this trade, we actually did this in this trade. Let me just clear this over here. Is we said, fantastic, we're happy with this movement. I think it was within the first hour of entering the trade, we actually moved our stop loss to break even. Actually, it was just beyond break even. So we guaranteed a very small profit, And this is what you regard as being risk-free. So now we're going to unfold the data. And we're also still paying attention to the dashboard, right? So now, at this point over here, the trend really moved nicely in our favor. This low, I'm going to make it as a black dash line, just got exceeded. So this is the first time we can move the question mark and say, okay, it's looking like a nice wave 4 into a wave 5 zone. So now we want to be on alert. We want to be on alert that we're coming towards this wave 5 zone. So we want to start locking in profits, but based on logic. So let's now just unfold data. What I did at this point now is I separate my 2 units. Right, half my trade, I'll go into a bit of detail here, I'll go relatively fast. I cover this in the entry to exit in terms of the 2 unit strategy. So half my position, I say I wanna keep my stop loss quite tight to the market. And then we had another swing low. Now we did something quite advanced yesterday. This was yesterday, literally, this particular trade. We exited yesterday. We had something called non-farm payroll, and there's a volatile piece of news that happens. Well, it actually impacts all markets, but especially Forex. So I wanted to be out of this trade before 1:30 p.m. Yesterday. So what we actually did was the market kept on moving in our favor, made another swing low, and we had our stop loss over here. But now, because we're approaching this wave 5 zone, and look at the momentum. The 4 hour is strong bull. The 1 hour is bull uptrend, and it says consider buying. Well, based on pattern position, we don't want to consider buying. We got a news announcement coming up. But what this indicates to me is we might be coming towards the end of a wave 5 zone. Let's get our stop loss incredibly tight to the market. And what we did was moving our whole stop loss onto what's called a 1 bar high. Basically, when a new bar forms, this is an hourly chart, so every hour there's a new bar. I'm moving the stop loss on a 1 bar high, 1 bar high, 1 bar high, locking in profits. And the reason I'm doing that, as opposed to just taking profits, in our trade plan, what we articulate really, really clearly is, and we went over this in the early part of this workshop, is no one knows what's going to happen. This market could just tank in a positive way, and we can make a lot of money. So we don't want to just exit. We don't know how low it's going to go, but we do know it's coming towards a high probability wave 5 zone. So what I'm going to do now, I'm going to actually zoom into this part of the market. And then every new bar, we're just moving the stop loss to what's called a 1 bar high. The next bar, moving it to a 1 bar high. The next bar, guess what? 1 bar high. Next bar, moving it to a 1 bar high. We're literally doing this hour by hour, right? And it's one of the pros and the cons of day trading. The pro is you can get really tight to the market. The con is you need to be in front of the computer hour by hour and just to quickly check and then readjust your stop loss. And that's a manual process. And then the next bar, this was the news announcement. Bang, it got stopped out for a very, very healthy profit. So that was the practical of what we covered in the theory before. I've got one more example that I want to fly through. But this example is a Bitcoin trade. I've got it over here. Oh, by the way, I'll just show you how this played out, right? So now this market with the euro US dollar, what I want to do next is look for an ABC correction for the next short trade. But this volatile piece of news, and it literally did this the next few hours afterwards. So we executed our plan to an exquisite degree, and we locked in because with our methodology, you're able to almost buy the top and sell the bottom and vice versa, or buy the bottom and sell the top, or sell the top and buy the bottom, and do some really, really accurate movements. But the main thing is that we keep it mechanical, really, really mechanical. But this was really, really powerful if you look at it, because we really maximized our profit. But the main thing wasn't the result. The result was good. It was good. Don't get me wrong. It was very, very good. But the main thing was how mechanical and objective it was. How simple, logical, and repeatable it was. And that means for the next 1,000 trades, we can apply the exact same thing. And I'm going to show you on the trend identifier dashboard, not the trend identifier dashboard, the trade simulator based on this trade performance, which is a good performance, is 150% risk reward. Ideally we want to get 200%, 300%, 500% risk reward where we can. But on this next trade I'm going to show you, which was the Bitcoin trade, this I'm going to show you as well. So the thesis on this was, let me just give you context. I'm just going to give you a bit of context, and then we'll just go into, I'll move through this one a bit faster because I'm aware of time. But this is the practical nature of trading. So the thesis is we've had this move to the downside, which looks like a nice 5-wave structure. So the trend is down. It looks like we've had this A, B, potential wave C correction, hence the question mark. So if it is a wave C, we anticipate the market to move to the downside to go below this low. Right? That's the thesis. And now we want to have the daily and the 1 hour, or the daily and the 4 hour in play, pointing in the same direction. So let's just now use this, and let's just zoom into this part over here and over here. I'm on an hourly chart. Yeah, perfect. So often you'll find what I do with my trades is, because sometimes whatever strategy you use, because sometimes you might tweak what I'm showing you based on your time availability, your risk tolerance, and your experience, is have a time frame for the higher degree trend, a time frame for the lower degree trend, and your entry time frame. The lower degree time frame trend can be the same as your entry time frame, or the entry time frame could be the next lower degree time frame after that. And that's what we're doing here. We're using daily as the higher degree, 4 hour as the lower degree, and the entry time frame on a 1 hour chart. This will make sense. So I'm just going to unfold some data. So what we have at the moment is I want to take a short position from a pattern perspective, but the momentum condition is not in play. It says the bigger trend is a bull uptrend. So the condition has not been met. The 4 hour, well, is irrelevant at the moment, whatever it is. I need to be patient and wait for this condition to be met. So let's just unfold some data on the hourly chart and just look at the dashboard. And now, 3 hours later, it says the bigger degree trend, which is the daily chart, is now strong overbought. So the upside should be limited. Now, at this moment in time as well, the 4 hour chart, which is the lower degree time frame, is bear downtrend, and it says consider selling. So I've programmed this in on how I speak to myself, as if I was speaking to you. So if I was saying, if your name was Joe, and I said, Joe, the higher degree time frame trend, which is the daily chart, is now overbought. So we can consider short positions if the lower degree time frame is also bearish. Now the condition has been met. I'll go, Joe, the condition has been met. We can now consider selling. Then it's your job to go, okay, what would be a logical point to enter based on high probability? Hopefully that makes sense. So now what I'm going to do is I'm going to zoom into this part of the market. Now what I liked about this, now this trade was a loss, right? But at this time, we wouldn't have known that. We wouldn't have known that. What I knew at this point was we had a nice move to the downside, which looks quite aggressive. It's bigger than any former move to the downside. So that could be an overbalance of price, or is. So I want to look for a short position below this swing low. That's what we said. And I want my stop loss above this swing high. And that's it. I'm going to risk 2% to find out if we're right. And this is actually what we did for the Done For You service. So here we said swing low. We could have been a bit more aggressive and gone on this swing low, but I chose to go on the wave 4 to be a bit more conservative. It's just a higher probability. So the green, I'm just going to change it to a full line. And I'm going to make this one red. This is the stop loss, just so you get a visual. And then I'm going to let the data unfold on the hourly chart. And boom. At that point, we would have got triggered into the trade. Now, as the trend unfolded, it's going sideways. And then it clearly moved in our direction. At this point, I asked myself, just the same way we did with the euro US dollar, what should the market not do if the trend is to continue to the downside? So we got to move there, we got to move here. If the trend is to continue to the downside, what should the market not do? Well, it shouldn't overlap back into this range, but we're quite close to the range over here. So what's the next thing it shouldn't do? Well, it shouldn't exceed this swing high over here. Now, notice that I said it shouldn't. I never said it can't, right? Really important. And that's the whole first part of this workshop about accepting responsibility. Anything can happen in the market, acceptable capital exposure, and so on and so forth. So what we did in this trade was at this point, we said, let's reduce our risk by moving our stop loss to this swing high. So now our 2% risk has now reduced to 1% risk. We still got risk on the table, but it's now 1% as opposed to 2%. So we've halved our risk, right? That's very healthy. That's elite trade management, risk management, capital preservation. So when we take a loss, rather than taking a 2% loss, we end up taking a 1% loss. Then as the trade unfolds, let's just unfold this data. Boom, stopped out of the trade. And then as the trade unfolds, the next bar, we would have got stopped out on the other one as well. So what we've done over here is what we've said is this market, at this point, we would not know what's going to happen. There's no way of knowing. But we know what shouldn't occur if the trend is to continue. That impacted our trade management decision making. If the trade overlaps, and especially if it goes over here above this point, what I've said in advance by moving my stop loss is I don't want to be in the trade. I want to be stopped out. It's my insurance policy, and then I can review. And now let's do the review. How do we review this trade? And hence the question mark, right? The question mark. So we go, we stopped out. We've taken a loss. I'm going to show you this in a trade simulator in a second. But now this is no longer a valid wave 5. Why? Because this high has been exceeded. So let's just now unfold the data to where we are right now as of this moment in time. This is where we are right now. And let's just reevaluate. Well, what this looks like to me now is this looks like the potential wave 5. This looks like the potential wave 3. This looks like the potential wave 4. And now we can reevaluate. That's simple. Is there another setup in play? Well, when it comes to early next week, we'll look. What I would like to see is that the market moves down, there's some type of ABC pullback, and then we'll look to short this as long as our momentum conditions are in play, and then we can look to trade. So the last thing I'm going to finish on before we open up the floor for any other Q&A that might pop in, we've got another 5 minutes, is I just wanted to show you the trade simulator. So this trade simulator If I just show it to you like this, so I can pull it up so you can have the numbers showing like so. In fact, I'll keep it like this. What I've done is our win for the euro US dollar was 152% risk reward, right? 152% risk reward. So I've just popped that into the trade simulator as 1.52. In terms of if we take a win, we make 1.52 what we risked. In other words, we're risking 2%. And in this trade, we made just over 3%. With the loss in the Bitcoin trade, we lost, it was actually 0.57%. Right? So we didn't lose 2%, we lost 1.14%. Right? So net, we're up overall. We've taken 2 trades this year, 2023, we got 2 trades so far. But let's just say this was our average result over the whole year and we did 100 trades. What would that look like? Well, this trade simulator, if you haven't played with it, it's fantastic. It took me a while to calculate, but it basically just randomly distributes these numbers and say, what would your year look like if these were your average results? So we're saying for every 10 trades that we take, we don't know what the result's going to be, but the average win is 1.52 risk reward. The average loss is minus 0.57, which is based on our Bitcoin number, and a draw is a draw. So 2 out of 10 being draws, 4 out of 10 being lose, and 4 out of 10 being wins. This is the number you want to pay attention to, which is the ROI. Now, we don't know what it's going to be, because remember, we don't have control over this. And this will make more sense to you, especially for the first part of the workshop. If I think it's Control D. Yeah. So you can see this year would have been, or this one would have been 77%. If I just kind of do random rolls of the dice, I see it as dice, 149%, 125% a year, 161% a year, 175%. And these are compounded results. I'm trying to see what's the worst year, if I can just see one that drops below 50%. What I'm trying to get across here is if this was your average result, but you traded this consistently with 50% losses, 50% wins, with good trade management, you can have a great year. And keeping in mind that getting 7% return in a year is incredibly difficult to do and to find, and to do that consistently year on year in, year out. Right, guys, we are coming up bang on 12 o'clock. So fantastic. I want to just finish on the slide. Let's just start with, or finish with the start. I want to go right to the first slide. The great thing about trading and TA is it turns the market into an endless stream of opportunities to enrich oneself. But rather than killing yourself in the markets, which is losing all your money, if you can get your trade plan in play, your edge in play, and then trade consistently and treat trading like a business, which is what it is. It's not a casino as a gambler, but that's what most people fall into. That's why 90 to 95% of people lose in the market. You want to be the casino, and the casino in the house always wins. The easiest way is double time frame momentum and pattern. And then if you can learn how to do Fibonacci price, that's a very, very powerful addition. And then after that, time ratios can be very powerful as well. So enjoy your weekend. We've got a fantastic 2023 planned. You have no idea what we've got planned for you, but it's all about practice, implementing this. The done for you is also moving to a new level as well. Got some new announcements that we're going to be making. So enjoy your weekend, and I'll see you very, very soon.